In this final lesson in our section on how to create three-statement projection models, we're going to take a look at some sample interview questions that you may get on this topic and how to properly answer them and address everything that might come up in the context of interviews. Now, to begin with, I want to note first that generally interview questions on this topic are pretty rare, simply because in investment banking and private equity interviews, they're going to focus on topics like basic accounting. So many of the questions that we saw in the previous course on making the three statements, on how changes flow through and affect the different statements. And then they're also going to ask questions about topics like equity value, enterprise value, valuation, DCF, merger and LBO models. But a standalone operating model like we have here is something that you're more likely to get questions on if you've actually created something like this in an internship or previous full-time job, or if you happen to be talking about it in the context of a case study or something else, some kind of modeling test that they give you on the spot at the time of your interview. With that said, I'm just going to go in and discuss a couple of the common questions that you may get on this topic now. So probably the most common question is to be asked to walk through a three-statement projection model like this, how you set it up, how everything flows through together. So to answer this one, remember that basically in our model, the revenue growth is the driver for everything else. And this is how real models also work. The revenue is the driver for everything else. You make expense projections based on the revenue, and then you make balance sheet assumptions based on what you have in your income statement. The way that everything links together is just linking together the three statements, which we went through in the previous course, but essentially the income statement will track revenue down to expenses, finishing with net income at the bottom. Then on the cash flow statement, you start with net income, you add back the non-cash charges, you take into account any changes on the balance sheet in terms of operating assets and liabilities, investing activities, and then financing. Then at the bottom, you have your increase or decrease in cash and cash equivalents. And then on the balance sheet, the cash links in from the cash flow statement. The changes in the other assets and liabilities have already been reflected. And then on the other side, shareholders' equity, the way everything links together here is that net income flows into retained earnings, and so that ensures that everything on both sides actually balances here. And the only difference for a three-statement model like this is that you're projecting it forward for 5 years. And again, the way you do that is you just make projections for the revenue and then tie expenses to that. Another question here is how far ahead do you project in a model like this? And usually the answer here is 5 to 10 years. The reason is that if you go beyond 10 years, it gets very, very difficult to predict what's going to happen to a specific company. It's very difficult to make projections that far into the future, so it's not really viable. You don't have the data most of the time. On the other hand, if you go below 5 years, it's more difficult to use the projections, for example, in a DCF analysis or with an LBO model or a number of other models that you might be looking at later on. So usually you want to model out at least 5 years, sometimes up to 10 years, depending on how much information you have. Another common question is how do you project revenue for a company? And there are basically three ways you can do this. Method one is what we have right here, where we just assume a simple growth percentage. So we assume that it grows by 10% or 15% or 20% each year. Method number two would be to do a unit by unit revenue build. So in our example here, this would be looking at the iPhone, the iPad, laptops, iPod, and all of Apple's other products, figuring out the growth rate in each of those and how the average price for those is changing over the years, and taking it from there and going with that. The third way of doing it is to do a tops-down revenue build, and this one works differently. In this one, instead of looking at individual unit sales and the growth and the average prices in units sold, what we do instead is we look at a market. So we can say the laptop market and then the smartphone market, for example. And what we do is we estimate the total market size for each of these and then the percent penetration for Apple. So we look at the laptop and smartphone markets and say, okay, they're 10 billion this year, they're going to 12 or 13 billion next year. Apple has 10% of the market this year, and we think that they're going to capture 11% next year. And so that's another way you could do this. In investment banking, usually the first two methods here are the most common, where you look at a unit by unit build, or you just make a simple percentage assumption that we have right here. But those are really the three main ways to do it. Again, I would say the first two are the most common in investment banking and private equity. A A related follow-up question is how do you make expense projections? So how do you figure out what cost of goods sold is? How do you figure out what operating expenses look like? And for this one, there are really two ways that you can do it. You can make simple percentage assumptions here and tie each of these to a percent of revenue as we have right here. Or you can do a unit by unit employee build. And in this one, again, what you do is you look at, say, the iPhone and you say, okay, it costs $200 to manufacture and ship this year. Next year, we think it's going to go down to $190. And in that case, you would tie it to the actual number of units sold and you would go from there with your projections. On the employee side, you would, again, link this to revenue, actually. And you would say that for X amount of revenue, you need X employees. And then you would look at their salary, benefits, bonuses, and so on, and you would look at how those actually change each year. And again, it would still be linked to revenue, but you would go into some more granular detail about how employees' salaries, benefits, and bonuses are actually tied together and how they actually show up and are summed up when you have operating expenses. So those are the two ways you can do it. If you have a lot of detailed information, you can do it the second way by looking at individual units or employees. Oftentimes in investment banking and in the context of interviews or modeling case studies, it's easier and better just to go with percentage assumptions because you just don't have the time or the data to actually make such a complex projection. Now, another question you can get is how do you project these items on the balance sheet? So accounts receivable, inventory, accounts payable, accrued expenses, deferred revenue, and so on. And for these, in 90% of cases, probably more than that, you actually just do exactly what we've done here. You just link them to revenue, COGS, operating expenses. Normally, you try to link the item to whatever is most relevant to it. So accounts receivable, that corresponds to how much the company is selling and getting from customers, so you link it to revenue. Inventory, well, inventory, as we know, is manufactured and turns into cost of goods sold, so you want to link it to that. Accounts payable can go with either COGS or operating expenses. Same with accrued expenses. It depends on the specific company and their situation. You see what we've done here, but this is certainly not an all-encompassing rule. This is just what we've done here. Usually you link it to either COGS or operating expenses. And even in complex models, you still do very simple assumptions for the most part for these items because it's just not worth it, and you're not going to get that much more detailed data by getting more complex than what we see here. Relating to the balance sheet, another question is how do you project capital expenditures and then depreciation and amortization, or just depreciation? And there are really two ways to do this. One way that we have right here is you can just do a simple percent of revenue assumption. The second method to project these is you could do a PP&E schedule. With the PP&E schedule, you split the PP&E into different assets and you look at land, buildings, equipment, factories, and so on. You figure out the depreciation of them over a certain number of years, however long the asset lasts for, its useful life, and then you figure out how much the company is actually investing each year in each asset, and you just split out everything into separate asset classes instead. One thing to note is that even with a PP&E schedule, everything effectively is still flowing in from revenue because your investments are going to be based on revenue, and so even then you're effectively still tying everything to revenue. It just looks more complex and there's some more detail behind the depreciation. Another common thing that you do here in addition to these two methods is you set CapEx equal to a percent of revenue, but then in many cases you set depreciation equal to CapEx. And the reason you do this is just to make your balance sheet and cash flow statement easier to analyze. If you know that depreciation is always equal to CapEx, then it's easy to go in and fix problems, and you know that you're not making assumptions that are too aggressive, and you know that funding a company's growth, investing, is also going to require depreciating assets over a certain number of years. You could also get asked about amortization of intangibles and how you project that. The easiest method here is, as we did in this model, to just go into a company's filings and pull it directly from there, because usually they have it projected out. If not, you would take the same approach that we saw with the PP&E schedule, where you split it into different asset classes and amortize it over a period of time. You could also set this to 0 or set it to a percent of revenue instead, but it's usually easiest just to pull this directly from the company's filings if they have it there. You could get asked about how to project interest rates on cash and debt. For cash, what you want to do is generally look at something like the LIBOR curve or other sources for interest rate projections. And to get a sense of what the cash looked like historically, the cash interest rates historically, you could go into a company's filings. So for this one, I would say for cash interest rate historical filings / LIBOR curves slash interest rate projections. On the debt interest rates, this one's a little different. You still look at LIBOR curves occasionally, but you also look at recent debt issuances, and you really take it from there. You look at similar companies with similar debt issuances, and that's how you determine the interest rate on debt most of the time. In our model here, we've done something very simple and just held it constant all the way across. Cash interest rates are changing a bit here. Oftentimes in models, you don't even get this complex. In a lot of cases, you just simplify it and you just say, okay, we're going to assume 4% cash interest each year, or for debt, we're going to assume 7% each year, and you don't even build in this option to let it be different in each year as we have done here. You may get asked about the effective tax rate and how to project that in a model. That one, again, you want to go off the company's historical filings. So rather than just assuming a 30% or 40% rate or whatever it is, you want to look at the filings and get the tax rate from there. The reason you do this is because oftentimes companies have foreign subsidiaries or some kind of unusual tax situation, so it's better just to get what they've paid historically as opposed to just making up your own numbers for this. Another question that could come up, less likely in the context of interviews, but another question is, what do you do if there's a problem in your error or a mistake? And we've been over this already. What you do here is on the balance sheet, basically what you want to do is look and verify that each item here matches up with something on the cash flow statement. If everything matches up, then what you want to do is go through and do a line-by-line audit, check all your sum formulas to make sure that it's nothing obvious, look at the absolute numerical difference between assets and liabilities and shareholders' equity, and just go from there. Try to do a very high-level view at first to make sure that it's nothing obvious and that everything matches up. If it's something more subtle, then you go line by line, and for each asset or liability or shareholders' equity item, you look and make sure that it's reflected once and only once on the cash flow statement. It does take some time depending on how complex a problem you have, but that's generally the best way to attack problems like that and also answer the question in interviews. You could also get asked about how deferred tax assets and liabilities work. This one is pretty simple, and we saw an example of how they actually arise in the context of models like this. A very common way in which they arise is when you record one expense for tax purposes for depreciation, and then for book purposes you record a different number for depreciation. That creates a temporary tax difference, and we saw how over time that corrects itself. Now in a model like this, the way we set it up here is we've recorded this deferred income tax expense on our cash flow statement. If our deferred income tax expense is going up, in other words, we're deferring some of these taxes, then our deferred tax asset is going down. Or if we have a deferred tax liability, that would be going up to match this deferred income tax expense. Another question you can get is, what do you actually use these projections for? So it's all well and good that we have them right here, but how do you actually use them? Most of the time, you'd use a model like this for your valuation. You would use it, for example, with an LBO model. You would use it in your merger model. And oftentimes, when you're presenting a company and trying to sell it to buyers or potential buyers, if you're working as the M&A advisor in the deal, you would send this model to the potential buyers. You would include it in the marketing materials and the presentations for a company. So essentially, oftentimes, projections like this serve as sales and marketing material for your company when you're representing it, they're your client, and you're actually trying to sell them to potential buyers. Now, on the flip side, if you're representing the company and you're trying to get the company to buy something else, so you're a buy-side advisor, oftentimes the projections you use will just be for internal purposes. You're not trying to sell it to anyone, so they're just for your own reference and for analyzing, for example, merger models and merger scenarios with potential sellers. Another question is, what do you do if your projections are too high or too low? And in that case, the answer is pretty simple. What you want to do there is split it into separate cases. So you might do an upside case, a middle case, and a downside case. Those are three common examples. And what you do here is maybe instead of 25% revenue growth, for the upside case, you could still keep that, but for the middle case, you might only have 15. For the downside case, you might have 10%. Now, this is actually a pretty large difference. In investment banking, it's questionable whether or not you'd really have a difference this big, but you'd have something like this. What you do is you split out everything by different cases. You'd have different revenue projections depending on the upside, middle of the road, and downside cases, and you could even do something different on the expense projection side as well. Generally, you'll keep balance sheet assumptions pretty much the same. Really, for different cases and looking at upside and downside scenarios, you're focused on the revenue and expense side. So that's a quick overview of some of the questions you're going to get or could potentially get on this topic in investment banking and private equity interviews. Again, I would really emphasize that these types of questions are going to be heavily dependent on your experience with this type of model and what you've done. They're not like other interview questions where everyone's going to get a question about how to value a company or how to do a DCF, because with a standalone operating model like this, so much of it depends on the company you worked with and the work you did. So that's a quick overview of what you might expect and the types of questions, but it's going to be heavily dependent on your own experience. Coming up next, we're going to be getting into equity value and enterprise value, and then we'll be moving into valuation, so how to actually go about valuing Apple, and then we'll be getting into some more advanced topics on merger models and LBO models once we're done with that.